Good morning and welcome to this Wednesday, January 8th edition of Trading Places Live at EarningsBeats.com. I'm Tom Bowley, Chief Market Strategist here at EarningsBeats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, overnight, kind of some excitement in the futures. We did have reports and confirmation that Iran has retaliated, sent missiles back into Iraq towards some of the areas where U.S. soldiers were being housed. Reports, I mean, I don't have all the reports up to date at this point, but the reaction to the strike initially was, as you might expect, a lot of selling. Futures overnight, the Dow Jones was down over 400 points, futures, but things have rebounded quite a bit. And last time I looked, our major indices had turned green. So we came back from that. I think maybe there was some relief that no energy areas, no oil fields, so forth were targeted. So anyhow, just wanted to give you that quick update in the event that you had not heard. As far as the action yesterday, let's go ahead and jump in, take a look here. It was... a little bit of profit taking. I'm not too surprised. I mentioned yesterday that the January 7th to January 10th period is really not a whole lot different than what we see during the 7th to the 10th throughout most calendar months. That tends to be a time where we see profit taking. The tendency is for most calendar months to end strong and then the following month to begin strong. And I think a lot of that has to do with money flows. As when I was in public accounting, I went out and I audited a lot of companies, and many of those companies have 401k plans, and most of the companies I audited would accumulate all of the monies collected from employees for 401k contributions and would remit those to the Vanguards, Fidelities of the world, and do so a lot of times beginning of the month. Many times it was middle month, end of month. And so when that money goes into those funds or those companies, Vanguard, Fidelity, and so forth, those companies don't have any say whether or not they invest. By law, they're mandated to invest as the individuals wish. So that money goes into the market. Again, Vanguard and Fidelity don't say, well, things are a little overbought, let me wait a couple days or a week. They can't do that. They have to put the money in. So there's always money flows coming into the stock market at the beginning of the month. Well, portfolio managers, hedge fund managers, and so forth, they know, market makers, they all know that money's coming in. So if you know money's coming in at the beginning of the month, the tendency will be to buy at the end of the month. And so there you have those trends. Well, once the market runs for about the first week, we tend to see profit taking. Now, this doesn't mean every single month this works out that way. If you look at the Dow, look at the beginning of December, it went down at the beginning, then rallied, then we had a little sideways action, rallied again. But the tendency, the historical tendency, is to see positive action end of a month, like the last 4 or 5 days of the month, and then heading into the first week of the next month, and then you get a profit-taking period. So yesterday we were down a little bit, but again, I think that kind of follows the general pattern, 7th through 10th. We'll see what happens the rest of this week, but this is the week where historically we could see a little bit of selling. The Dow finished down 119 points yesterday, the S&P 9, NASDAQ about 3 points, and small caps, the S&P 600 small cap fell about 5 2/3 points. The 10-year Treasury yield, actually, that's not updated. Let me get you a quick update here. We are currently sitting at 182, hasn't really changed much, down a little less than 1 basis point today. We'll talk about that, the 10-year Treasury yield in just a minute. Looking at strength yesterday, the only sector that was higher yesterday was communication services. So here was a little bit of a movement to the upside, continuing the bullish action that we've seen off of that October low. So communication services continues to look strong. Trucking, this is industry group obviously, but truckers had a good day yesterday, up almost 1.5%. I'm going to talk a lot about the transportations in just a bit, so let's keep moving. Semiconductors also had a nice day yesterday, up 1.25%, bouncing off of that 20-day moving average test. So that was a bullish rebound there. To the downside, and I actually find this to be somewhat comforting. We had a down day and 2 of the defensive groups were leading the selling. So it wasn't a lot of profit taking in the more aggressive, higher growth areas like technology and so forth. It was real estate and consumer staples. Real estate pulled back. Consumer staples had made a pretty nice run in the month of December, so I think we're seeing a little consolidation, a little profit taking right now. I suspect if we get back down to around the mid 61s, 61 and a half, 61 and 3/4, probably start to see a little bit more buying in that area. All right, there was an economic report out today, ADP employment report. I don't pay attention to this one nearly as much as non-farm payrolls, because I think non-farm payrolls is the one that the market watches most closely. And many times these reports don't go hand in hand. You would think they would, but they don't. I believe it was last month, ADP employment came out, was very disappointing. And then non-farm payrolls blew it out of the water. So keep that in mind. But December ADP employment report was out this morning at 8:15 and showed a very strong number, 202,000 versus 157,000. And November was revised higher from 67,000 to 124,000. So a very, very strong ADP employment report. You would think that the 10-year Treasury yield would jump on that report. But again, I don't believe this is the report that our financial markets are watching most closely. I think it's going to be the non-farm payrolls on Friday. So we'll see what happens then. But you can see this week the 10-year Treasury yield is up a little bit from last week, trying to get back through that 20-week moving average. Now, I could annotate this and just I've told you and shown you many different ways why I believe this is a key area for the market. We could probably put the lows in there and then maybe again right about in here. But here was a prior low all the way back in September of 2017. We can see we came down into this area again in the middle of 2019 and then completely fell apart. Now we're coming back up. We've seen some tests here, moving back below. Are we rolling over, or are we going to come back up and break out? I think that's probably in the short term one of the biggest questions, because if the 10-year Treasury yield moves higher, there's an excellent chance the stock market is not done and we're going to go higher. So watching this area of resistance, I think, will be very important. All right, I am going to move into an area I like to call talking technically. And I want to start by pulling up, let's see, I've got it here somewhere. I'm going to pull up a chart on the transports versus the S&P 500. I've shown this many times. You've probably seen it. If you haven't, you need to pay attention because this is really important. When the S&P 500 consolidates, it's generally because of a weak transportation group. When the S&P 500 is flying, it's typically because of a very strong transportation group. So when we get a big move, when transports make a big move up, the S&P makes a big move up, then we go through these consolidation periods where transports struggle. They don't make a new high. You can see the S&P trying to go higher, but transport's not supporting it. It really gets back to the Dow theory. Then when finally we get the move on transports, look what happens to the S&P. Then the S&P keeps trying to go higher. Transport's not supporting it. Finally, we get the break on transports. The S&P breaks, and then we have a big move. Check this out. Last 19 months or 17 months, whatever it's been, sideways consolidation. Well, actually, this sideways consolidation was last year I'm showing. But literally, we could pretty much go all the way back here. There hasn't been a whole lot of action to the upside in the S&P for really almost 2 years, from January 2018 until about October of 2019. But throughout this period, the S&P kept trying to go higher. What were transports doing? They were going down. They were not supporting it. This is common sense to me. The reason this happens is transports. How does the economy grow without transport stocks performing well? I don't know of a way. I mean, you can't ship more goods. Yeah, I mean, I guess services, you can do services. They don't really require the transports. But in terms of the overall economic growth expanding and continuing, we need transports to do well. So when transports start to show strength, that's when we need to pay attention. We are now, transports, by the way, just back in October, moved to about a 52-week, actually more than a 52-week high. So that was an important first step. Now, we haven't taken out that quarter three 2018 high, but I believe the downtrend has ended. When you see the S&P breakout in back here, the transports hadn't taken out the prior high. They simply had reversed the downtrend. I think that's what's taking place right now, and I think that is one of the bullish reasons, or one of the reasons why the secular bull market is beginning a new leg. I think it's because the transports made that breakout back in early October. And I talked about this. I really felt like the transports were a major area that if we wanted to have a big rally, and I think if we're going to have a big rally in 2020, the transports have to be among the leaders. So looking at this, I'm going to pull up the transports. This is a candlestick chart going back the last 10 years. And you can see, I want you to look at how this evolves. So in 2011, transports go up, they pull back, they come back up, they got this downtrend. Notice how the moving averages don't really mean anything. When you're in a trendless market, moving averages, you know, I've seen folks look at, say, oh, it's testing its 20-day, oh, it's testing its 50-day, oh, it's testing its 20-day. Well, it just continually did that. When you have a trendless market, moving averages go nowhere. So you just constantly go above, below, above, below. When you're in a trending market, that's when you want to pay attention to your moving averages. So notice when we made the breakout here, we didn't go back down below this 20-week, or excuse me, 20-week moving average with any gusto for 2 years. I mean, literally it was this, but then we came right back up. It wasn't until we rolled over again during the next consolidation phase. This was a strong move in transports. When we went through the next consolidation, downtrend, when we finally broke through, notice it's holding its 20-week moving average. Just like here, once it broke through, it held its 20-week moving average. Big move up. Now, we did pull back a little bit here and go below the 20. We never lost the 50 throughout the entire uptrend. Same thing here, never lost that 50-week moving average. So maybe the 50-week is what you want to pay attention to. But then we went through the consolidation with the transports, and now, in my opinion, we're just breaking this downtrend line. Look, notice we're holding that 20-week moving average. That's going to be important to the downside in the near term. If we were to go back on the transports below 10,500, I think I'd have to reevaluate. I still would believe we're in a secular bull market, but we might not be ready to just take off. We may consolidate for a while longer. So watch 10.5 to the downside. Otherwise, if we break back out again to take out the highs that we saw in the fourth quarter of 2019 on the transports, I think that would be incredibly bullish. All right, so here's the transports over these 10 years. Let's look at the truckers. Here was the period. Truckers are down. You can see we came back up. I'm going to flip back and forth so you can see this transportation chart. See 2011, 2012. Let's go back to the truckers, 2011, 2012. When we broke this, check out the truckers. Now, the only thing I would say is here we had a little bit of a blip where we went below the 50-period moving average, and here the PPO turned a little negative. But we were clearly putting in higher highs and higher lows throughout until we got to 2015, 2016. What happened? Well, we had this downtrend 2015, 2016. We broke out in the second half of 2016. Go back to the truckers. Second half 2016, what happens? We make this big breakout. We did come below the 50, but this to me just looks like nothing more than just a price support test from the breakout level. And then we went up, continued pushing higher until we went through our consolidation period once again. Now, I think in the fourth quarter, I'm not sure if this looked like a pretty good move. We got on the transports. We also made that little bit of a break. If you connect those two highs, we made a break on the truckers, pulled back, so far holding that 20-week moving average and turning back up off of it. A break back up above about 910, 920 on the truckers would be incredibly bullish. Watch for that. All right, let's take a look now at the railroads. Sideways consolidation, actually made a little bit of a break here, pulled back, and then look at this move throughout that solid S&P 500 advance. Look at what the railroads were doing. Really important. Then we go into 2015, 2016. There's your downtrend on the transports with the breakout in the fourth quarter of 2016. Here's your railroads. By the time we got to the fourth quarter of 2016, look at what was happening. Railroads holding on to that 20-week moving average. One time moving below, and actually that was after the high that we had established, but there was your move below the 50. railroads have actually continued to perform pretty well. And I think they're in a very, very bullish formation here. Looking at this chart, you can see this. This is actually an inverse head and shoulder pattern. It's hard to see it, but I'm going to pull up let's look at maybe a 2-year chart. Go to a daily chart. All right, so here I think hopefully you can see. Here was the top, left shoulder, neckline. Go all the way down here, put in the head, come all the way back up, right side of the neckline. Here's your right shoulder, almost perfectly even with the left shoulder. And now we're moving back up. A breakout on the railroads above 25, let's call it 25.10 or so. That measures almost 21.10. That's 400 points. Yesterday, I talked about the measurement on the internet stocks going up 20%. Well, here's the railroads going up, 17%. Pretty important stuff. These patterns are really important because they give us measurements. So we get the transports going, we get the breakout on railroads, we've gotten the breakout on internets. We already know semiconductors are hot, computer hardware. It's just, one group after another jumping on the back of this bull market. It's going to be very hard for bears to get control. So watch for this breakout on the railroads. All right, let's move on to earnings. There were some earnings reports out. First one, Walgreens Boots Alliance, so WBA. They came out, missed revenues, missed earnings per share. Not by a lot, but they did miss. They're down 6% in pre-market, which takes them probably down here close to this, 56 and change area. If it opens and closes below the mid-December low, I would not find that to be very encouraging. If it does gap down, though, and we see a very strong hollow candle, big recovery, I think the worst has already been built into WBA if that's the way it reacts to an earnings miss and a revenue miss. So I think today's reaction to the earnings is going to be really important for Walgreens. STZ. Constellation Brands, I didn't see their revenues, but they did beat on the bottom line. 214 versus 185. Stock up 4% in pre-market, which would be roughly about $7. That would take it up around 190. Can we get through, excuse me, can we get through that 190 level? Or are we going to turn right back around to the downside? I'm a little concerned about the chart still on a relative strength basis. I mean, I don't know if they beat on the top line, but if they beat on the top line, they beat on the bottom line, they gap up and it doesn't stick, then I would be a little concerned. I would watch yesterday's close as their first area of support, which is 183.60. And then I would be watching from a longer term perspective, 170 to 175. Very important support on Constellation Brands. Lennar reported big numbers. Big beat on the revenue, $6.97 billion versus $6.60 billion. And bottom line, $213 versus $1.90. Stock up 3% pre-market, going to take out what I think has been this bear. It's actually a bull wedge. It's been a bear trend to the downside, but it's a bull wedge or a bull channel to the downside that when broken to the upside likely leads to another push higher. So I would be looking for continuing advance on Lennar. Now, you might gap up and then come back down, fill the gap. But I think the next move, is it a close above the 50 or is it close below 55? That's what I'd be watching here. RPM reported this morning. They beat on the top line just by a bit, beat on the bottom line, 76 cents versus 73 cents. They guided Q3 earnings per share lower. But the stock is still up 1.3% pre-market. So up a little bit. Let's see if we can hold on to the 50-day. If because of that warning, that would make me just a little bit more suspicious of a gap up. If all of a sudden big selling comes in and we can't hold that 50-day moving average, I'd be a little careful. MSM also beat top and bottom line and also guided lower. This one I'm not as excited about. Look at the relative strength here versus the industrial suppliers. I would be careful with MSM. The stock is down 1.3% pre-market. This is an area where it needs to hold. Right here at about the 76 level, 50-day moving average, you give them maybe just a little bit of room below. But it's going to open pretty close to that 50-day. And unless we get a big reversing candle, I'd be a little nervous with MSM. Two stocks that will be reporting after the bell. Helen of Troy, HELE, great looking chart, great looking relative strength. I'll be surprised if they don't come out with another solid report. Look at the last three, big gap up, big gap up, big gap up, and then sell off. But I think a lot of that's just gimmick, market maker manipulation. We gapped up, held the prior lows, and now look, we come right back. So look for a good report. Whether it gaps up or not is always a, kind of a coin toss, but I do expect a good report out of HELE. And then tonight, Best Buy, or excuse me, I always say Best Buy, Bed Bath & Beyond. I wrote about this one in the EarningsBeats Digest this morning. It's a free newsletter, by the way. Monday, Wednesday, and Friday it comes out. So make sure you check that out. Go to EarningsBeats.com, and you can sign up for it on our homepage. But it is a free newsletter. I just simply wrote about Bed Bath & Beyond because it's performing really well, had a nice gap up with earnings back in October. It's been showing really nice relative strength. And this one is going to have some issues potentially if it doesn't keep going higher. I want to show you the long-term chart on this stock. Here you can see a possible reverse head and shoulder. So right around that 18 level, we want to get a breakout above that. But if we come out with earnings and they're not so great and we pull back and we hold that 20-week moving average, that could be a real shallow reverse right shoulder. Breakout above 18, no matter how you slice it here, 18, 18 and a half would be really bullish for the stock. But check out this, really since back the end of 2013, it's been a 7-year decline for Bed Bath & Beyond. Look at the specialty retailers during this period. So look at the relative strength. Now it's starting to show strength. Is it going to continue? I don't know. We'll see. All right, let's move into upgrades and downgrades before we get into the three you must see. So upgrades and downgrades. First, we're going to go into Sienna. Sienna was upgraded today. I like the chart, the big move up here with earnings. It's been pulling back here the last 3 or 4 days. I think eventually it breaks out. The big problem with Sienna is telecommunications. Telecommunications has been weak. You can see Sienna has been pretty strong. It's just, it's in a bad area. So yes, it's one of the best in telecom equipment, but telecom equipment's not getting its fair share of the money in the market. So that's been holding stock back, but I do like the stock. I'm okay with this upgrade. COMM, CommScope, you can see this one, big move up. I believe that was earnings. I'm not positive, but notice that if I drew a line, I'm not going to annotate just for time purposes here, but the top of gap support, when you get these big moves on heavy volume, top of gap support tends to hold its support. Notice it's been holding. Let's see if it continues. The upgrade I'm okay with, but if we closed below about 1250 to 1275, I'd be careful. Downgrades, let's pull up a couple of these. BDX, this is Becton Dickinson and Company. This is in the medical supplies area, and it's been actually moving higher on both an absolute and relative basis. I like the breakout above this double top here around 262, 263. Could we get back down there? Sure. Maybe we'll get a little move down with this downgrade. Who knows? But I think this is a stock that holds its 50-day moving average going forward. So I would tend to disagree, maybe use that potential short-term weakness as an opportunity. All right, let's do one more. Let's see, Win Resorts, Win Resorts, not resources, Win Resorts. We know the gambling stocks have been really hot of late. You can see that on Win's chart. Big move up. It's being downgraded today. I do have a little bit of a problem with Win in that it had been in a longer-term relative downtrend. So it was not one of the leaders in the space, but the last 3 or 4 weeks, we're starting to see that, and we're getting the volume. We're getting the big pickup in movement to the upside. I don't know. It seems like this downgrade may create an opportunity down to 20-day moving average if we get there. So keep that in mind. Also wanted to mention yesterday, I went through Citigroup, which had gone and initiated coverage. I believe it was initiation, but they had initiated coverage, I think, on a number of healthcare stocks. And I was looking through upgrades, downgrades, initiated stocks and so forth this morning. And I saw Wells Fargo was doing the exact same thing. I don't know if Citigroup called Wells Fargo and said, hey, why don't you all do an initiation event? Same stocks just about, kind of weird. But anyway, I thought I'd point out a couple of these. Wells Fargo is rating a few of these as buys. Let's pull up AVTR. They're calling this one a buy. Now, it's got overhead resistance. It has been a strong performer the past few months. You can see that relative strength has really been taking off. But let's see whether or not this can hold. And actually, maybe they did more than just healthcare. This one is not a healthcare stock. My bad. But I know this one is, and I think this one also was initiated with a buy yesterday at Citigroup. This is Biorad Labs. Nice breakout yesterday. That was on the buy from Citigroup. Now today we've got, I think it's an overweight. That was, I don't remember the exact what they called it. I think it was overweight by Wells Fargo. But I'd be looking for additional movement to the upside. Really nice relative strength, getting close to a 52-week high relative to the medical equipment group. Nice volume trends coming in. I suspect we'll see higher prices. 20-day test would probably be the best area there to enter. Among the stocks that they actually said no to, HOLX, which is Hologics, they just said equal weight. They didn't really say to sell. They just said equal weight. I actually like HOLX. I am going to be sending out in our daily market report later today to our members the top 15 stocks. We're going to have a webinar next Monday, and we're going to talk about those then. I'll go over all the charts. But I'm going to send all those to our members today so you have those ahead of the webinar next Monday. If you're interested and you want to get those today, be sure to sign up for EarningsBeats. We have a $7 30-day trial, so feel free to check us out. But Hologics I really like. Here's the breakout, pullback test, and now we're moving higher. And the thing that I really like about it is when you look more at a longer-term basis. See, stock didn't do a whole lot for several years, and now it's starting to trend higher. So I think that could lead to a really nice 2020. And then one stock I'll give you before the 3 and 3 that they actually issued an underweight on is Illumina. And Citigroup yesterday came out and I think rated this one a buy. I was hesitating to agree with them. Yes, it's a really good long-term performer, but look at the relative strength. It just hasn't been doing anything. Lately, last 6 weeks or so, it's just kind of going along for the ride. You can kind of see the biotechs, and then you can kind of see ILMN doing the same thing. So I would kind of agree. I mean, I think the stock goes higher because I like biotechs. I just don't know that this one will be a leader. Watch the relative strength line. All right, let's move on to the 3 you must see. I always like to end the show with this. And the first one I want to mention is DGII. You can see the gap up there. And right here is the gap up on volume. And that's where the buyers came in that day. So we opened near 17, went all the way down close to 16, then turned around and came back up. Look at where the buyers have come back in recently. So we got up to 19. We come all the way back to this level, just below 17. 7, 8 trading days later, we're right back to 19. That's a 10% move in a short period. Now we're coming back down. I really believe the 1690 down to about 1610 area is a level to watch really closely if we get down into there. Just based on the volume trends, I really like this one. It is a smaller company, less volume, so a little bit more risk. So make sure you're okay with that. But otherwise, I think this one looks pretty good. Next up is Polaris, PII. Now, Polaris is doing almost the exact same thing. It's going back down to a key support on that candle body. So here's the big volume gap up, very close to a Maribozu candle where you open on the low and close on the high. We didn't quite close on the high, but that's pretty strong demand when you get big volume in that kind of a candlestick. So we get up, couldn't get any higher, put in a negative divergence here, tested the 50, tested this price support. Once again, in about 7 or 8 trading days, we go from 93 up to 103, another 10% move. This is why we do what we do. This is why we trade. And then couldn't break out. And then yesterday, right back down to test this level again. I would expect we'll see a bounce on PII back toward the upper end of this range. But that lower end continues to be a buy as long as it holds. Well, it's still a buy. But if it doesn't hold, then I would quickly exit. Final stock is going to be Akamai, AKAM. Really like the breakout here. This was a stock that had moved up, put in a double top, consolidated, looked like it was underperforming and drifting lower, which it was. Many stocks underperform when they consolidate. Look at that underperformance while internet's continued going higher. But this breakout on increasing volume, I think, could mean something longer term on Akamai. You can see a lot of sideways action. We just broke out back in the middle of 2019, tested it, and now we're starting to turn back up. I think this is one to watch for 2020. All right, I want to thank everybody for stopping by today. Hope you have a good day, and hopefully the market handles the news overnight of those Iranian missiles fairly well. The futures recovered. We'll see what happens in the market today. Just keep in mind this is a profit-taking week historically for the market. Everybody have a great day, and see you tomorrow over at Stock Charts for Trading Places Live at 9 a.m. Eastern. Have a great day, everybody. Happy trading.